Today we will learn about how we pay for government services with tax money. The government provides a wide variety of services to its citizens. At the local level, these services include building roads, education, and law enforcement. At the state level, the government also helps pay for building roadways and education, but also the operating expenses for the state government, like the governor and the state legislature. At the national level, the government pays for national defense, Social Security for the elderly, and paying federal lawmakers like senators, representatives, and the president. We call the money the government raises to pay for these services income, or revenue, and the largest source of revenue is taxes. The government raises money to pay for all these services by collecting taxes. Taxes have been around for a long time. Ancient Mesopotamian farmers paid taxes by giving a portion of their crops and livestock to the government. In ancient Rome, citizens paid property, real estate, and sales tax, much as we do today. And in colonial America, citizens' feelings of resentment over taxes led to the War for Independence. In 1776, an English economist named Adam Smith came up with a guideline for fair taxation. First, taxes should be based on a person's ability to pay, meaning wealthier people should pay more and poorer people should pay less. This is called a progressive tax. A progressive tax is when people who earn more money pay a higher tax rate than people who earn less money. Smith's second guideline requires that a tax should be clear and straightforward. This way, people can figure out exactly how much they owe in taxes and therefore plan their finances wisely. Third, taxes should be collected in the most convenient way possible. For example, sales tax on an item is conveniently paid when you buy that item. Finally, each type of tax should be collected efficiently, meaning a small portion of the revenue should pay for the collection of the tax, but the rest of the revenue should be spent on the public good. Here are the three most common types of taxes in America. 1. Sales tax. This is tax paid when you buy something. For example, if you want to buy a $1 candy bar and you live in an area that charges 7% sales tax, the candy bar will actually cost $1.07, including tax. Next is property tax. Property tax is a tax you pay on any land or homes that you own. This money is usually paid each month as part of your mortgage and goes to the local government. The final type of tax we will study today is income tax. Income taxes are taxes taken out of your paycheck. Both the state and national government take income taxes out of your pay. Now, there are three main types of income tax. The first type we've already learned about. It's called the progressive tax, the kind that increases with your income level. As opposed to the next type, a regressive tax, where the more money you earn, the less you pay in taxes. The final type is called a flat tax, in which everyone is required to pay the same amount of taxes no matter how much money they earn. The next topic we are going to discuss is the government budget. We've already discussed that the money the government brings in from taxes is called revenue, and we call the money the government pays out in expenses expenditures. To determine how much revenue will be received and how many expenditures can be made, Congress writes a federal budget for the entire national government. The federal budget is a yearly plan that outlines revenues and expenditures for the upcoming year. When the government spends more money than it takes in, it's called a budget deficit. And when the government receives more money than it spends, it's called a budget surplus. When revenue is equal to expenditures, it is called a balanced budget. Most years, the government runs a budget deficit, meaning they spend more money than they bring in. When this happens, the government borrows money by selling bonds. A bond is when someone loans the government money that must be paid back with interest at a predetermined date. For example, if you buy a $1,000 30-year bond from the U.S. government at a specified interest rate, you are loaning them the money for 30 years, and then they must pay you back the money, plus the interest. All of the money the government has borrowed and currently owes is called the national debt. In 1960, the national debt was about $289 billion. By 1998, it was about $5.5 trillion. And in 2018, the national debt stands at about $21 trillion. So, in summary, the government pays for a lot of public services. We call these expenditures. They raise money to pay for these expenditures by collecting taxes. We call this revenue. The main types of taxes are sales tax, property tax, and income tax. The U.S. uses a progressive income tax, meaning the more money you make, the more money you pay. The federal government has a federal budget. They usually go over, and this is called a budget deficit. To cover the budget deficit, they borrow money from people in the form of bonds, and then they must pay them back with interest. And that is how the government pays for government services with taxes.